Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. And today's question is an interesting one because it's something that all of us have experienced in our investing career. A trade that appears to be just too good to be true. Today's question comes from Marc from Luxembourg, Europe. Alan, perhaps I found something too good to be true in the world of covered call writing. On February 1st, BIDU is trading at 107.20, and the February 8th weekly $100 call option is at a bid price of $8.80. This leaves us a huge one-week profit and appears to be a no-brainer. You can only win, or is there a hidden worm? Well, Mark, whenever a trade appears to be too good to be true, it usually is, because there is no free lunch in investing. So let's first take a look at the trade as you've described it. You're going to purchase 100 shares of BIDU at 107.20 and then sell the February 8th $100 call option for $8.80. That breaks down as follows. Of the $8.80, $7.20 is intrinsic value, or in the money, and $1.60 is time value, our initial profit. So if we use the $7.20 to buy down our cost basis from 107.20 down to 100, that leaves us a 16% one-week return, a huge profit as you stated in your question. Now, let's take a look at the chart at the time that you posed this question. As you can see, over the last few months, BIDU has been a declining stock. However, in the last month and a half or so, it has been accelerating in price. So from that perspective, it is a possible eligible covered call writing candidate. Now, the next question we ask ourselves is, why is the time value of that option premium so high? Because that means that there's a lot of implied volatility in it. The market is anticipating a big price change, which could be in either direction. The first thing I would always look at when you have such a high return with such little time remaining until expiration is to check to see if there's an upcoming earnings report. And as it turns out, there is an upcoming earnings report on February 4th after market close. And that will explain the very high option return for that particular $100 call option. Now, in the BCI methodology, there is a very firm rule. We never sell a covered call option if there's an upcoming earnings report prior to expiration of the contract. So you would never be in this position if you follow the BCI methodology. So now let's take a look at the chart after the earnings report has passed. And as you can see on the screenshot in front of you, the earnings report was disappointing and the price of the stock plummeted almost 20 points since the day you were considering entering that trade. So you would have lost $20 per share after having gained $8.80 on the option premium. It would have been a major, major loss to you. So once again, in the BCI methodology, we never ever sell a covered call if there's an upcoming earnings report prior to expiration of the contract. And keep in mind that if a trade appears to be too good to be true, it is, and generally speaking, something we should all avoid. Mark, a very, very good question. I think many of our members will benefit from that question. Thanks to you for asking it, and thanks to all of you out there for watching this video. As always, this is Ellman, the blue collar investor. Take care, everybody.